Hi, and welcome to another video from the Red Candlestick. Today we're gonna be going into something a little bit different. Well, actually, basically the same. Same type of, outline. And we're gonna be going over emerging markets and why I believe that emerging markets are going to outperform developed markets in the coming years. Now, as always, I am looking at I wouldn't like to say, maybe kind of like a quant. I'm looking at macro data right here. Now, obviously, a singular investment, it can be in wherever in the world and still be a great thing. But it's important to understand where there are the most good investments. Now, here we can see the GDP growth of high-income countries, which are countries making more than 13,000 a year, and upper middle income countries, which are countries where people make like between, I don't know, it's a huge distribution. It's like 4,000 to 13,000. So people make in between those amounts in these upper middle income countries. So they're not necessarily third world countries. They're upper middle. Um, and the reason why I put upper middle is to understand that there's a difference between a frontier market and an emerging market. Emerging markets are like China, Russia, Brazil, Turkey, and frontier markets are like, I don't know, Rwanda, Tanzania, or something. Something just way out there. So, if we go up here, we can see the population of upper middle income countries is much, much higher, despite high income countries composing more of the economy. Actually, GDP. Let's actually show that. See, high income countries compose more of the economy than upper middle income countries, despite upper middle income countries having double. Now, that's pretty important to understand, because one thing that could help upper middle income countries, unlike high income countries, is that upper middle income countries, despite being quite low to where it probably should be, it's at 20% of their population is 0 to 14, while in high income countries it's only 16% and drastically decreasing. Now, I will say, part of the reason why upper middle income countries have such a low 0 to 14 percentage of population is because of what has gone on in communist countries. Because many of the communist countries are now ex-communist countries. So China, Russia, and what happened in those countries is quite disturbing. There were times of where they controlled the population of these countries, and that means, as you can see, there used to be a lot more of 0 to 14, but it drastically decreased because they changed the culture to not produce as many babies. So that's just something, a little bit of history. Here, we can see this I will explain why I compared specifically TLH to an emerging market bonds, but we can see that emerging market bonds have slightly outperformed this, which is 10 to 20 year bonds, and it mostly has to do with appreciation, like many of the last videos, how we showed that. Now, if we compare it to TLT, which is 20-year plus bonds, TLT has outperformed. The yields are still higher on emerging market bonds because the credit quality is not the best, but they still have performed pretty well with their risk. So a lot of 20-year plus, but also a lot of lower. So that's kind of why I compared it, because this has 15 to 20 years mostly, which is sounds about right to me. So very, very similar. Also, if you look up here, trailing 12-month yield 4%, average yield maturity 4.77, TLH it's only 1.8. Even if I go to TLT, still gonna be much lower than that. And part of the reason why is because there's lower credit scores. Yeah, see, it's still much lower than 4.77. Now we'll be looking at Chinese bond, which have gotten a 2.9% yield on, and they have, gone down in yield. Brazilian have gone up in yield, over 11%, and Russian are like 8.3. Now the reason why I'm showing you this is to compare it. These are the three largest in order of, upper middle income countries. Now, if we compare that to, the biggest, high income country, which is the United States, as expected, 1.5% on a 10-year. That's lower than all of them. This is even worse. Japan is the second biggest high income country, and it's basically 0.07%. That's actually insane. But, and remember, Japan is a very indebted country. Actually, I might want to show that. Let's remove these. Seriously, when I say debt to GDP, okay. When I say, look at this, Japan, it's higher than any other country, and these are pretty bad countries down here. Geez, like, I don't know what Japan is up to, but like, what in the world? I could actually go into more detail why this happened in Japan, but I can't really do that in this video, basically because I don't have enough time in the day to talk about that. It's really complicated, and it has to do with deflation. Now, 10-year German bonds, negative 0.3%. That was worse than even, I have to say, that was even worse than Japan. In the West, we live in a not just low interest rate environment. We have debt. We have a lot of debt that is sub-zero, as you can see here. Germany is a great example. Switzerland's a great example. Netherlands is a great example. We have a lot of negative yield debt. And it's, I don't know if that's exactly good. I really question how great that will be in long term. Don't ask me, but I think it's bubble-ish behavior, obviously, I can't really, give any financial advice, but I think it's bubble-ish behavior. So if we look at the China USD pair, we can see that the Chinese yuan has been going up a lot, over the year. And I went into this in the last video, why I believe that, actually, not the last video, but the first video that I made on this channel, and why I believe that, the U.S. is in a bond bubble, but I probably shouldn't have said it like that, but it's, it's my belief. As you can see, the Chinese yuan has gone up a lot, against the U.S. dollar. So has the U.S. dollar against its, currencies around it, but this causes, since a lot of stuff is denominated in Chinese yuan, this causes prices to go up. We'll get in further. So in Brazil, we can see that the currency, even though it had a huge boom, just like many other currencies had a huge boom against the US dollar, because there was a lot of lost faith compared to other currencies in the US dollar. Now it's about the same. And this is expected because Brazil has generally seen quite high inflation. Now here's another. Now the Russian ruble. Oh, I'm good. Now the Russian ruble has been trading sideways too for the past year, and obviously it had a huge jump, just like many others. And well, part of the reason why Russia's ruble has gone down in value is because of increasing interest rates in Russia, combined with high inflation. Now, obviously, it's not because of the increase in interest rates, because over the long term, an increase in interest rates will improve the currency, because it decentralizes debt. But it can also do the opposite for foreign investors, because it shows that the currency has weakened. And inflation is high. Now, if you look at China's inflation, China has a very low inflation against it. This probably is part of the reason why the Chinese currency has gone up in value. Many people do not know that China has quite a low inflation rate. Now, they had pretty high inflation during this time, but usually it's quite low. It's 2-3% inflation, and that explains why they have gone up against the US dollar. Now, if you look at the ones that have been trading sideways, both of them have very high inflation, and usually very high inflation. Their inflation was actually quite low for a little bit. I mean, surprisingly low, and this was because this was a time period where interest rates were rising, so, like, around the world. So, not just in, because, if they were rising, actually, I don't know. Honestly, some of this, yeah, they were decreasing. They were decreasing here, but around the world they were increasing. That's the thing I know. Like, in the U.S., they were trying to increase interest rates in 2018. And I guess inflation went down when interest rates went down here, but the interest rates probably went down because of foreign investment going down. So that kind of makes sense why their inflation would go down. But, see, usually their inflation is very high. That's the thing that you need to understand about that. Now, main thing, we can look at China against the United States, and we can see that China has outperformed the United States almost always. Last time that they did not was 1976, and that was before they reformed from their communist practices. So, final thing, we can look at a major emerging market ETF and look at a major U.S. market ETF. So, iShares MSCI emerging market ETF, average PE about 15, price to book about 2, and 1.5 price to sales, and about 10 times free cash flow. Now, if you look here at the S&P 500 ETF, 26.5 PE, 4.5 book, 3 times sales, and 17.5 times free cash flow. So if we see here, it's about double in the US. And based off the growth in emerging markets, this would say that this is probably more than twice as cheap. This is multiple times cheaper than the S&P 500. Now, the S&P 500 right now is in a very, very high, against their PEs and their evaluations. The U.S. market has very, very high evaluations, and part of the reason why is because, look at these interest rates in Western nations. Some of them are negative yield, 0 yield, and 1.5 yield. That is horrible. So it's explainable, and that's just what happens. And you can't really prevent it. It's just what happens. So yeah, I believe that emerging markets will outperform developed markets.